Market to Market is everywhere you are. Subscribe to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
Welcome into the Friday, June 24, 2022 Market Plus. Joining us again, John Roach. John, we usually call you the senior market analyst, which just, it's only because you've been here a couple of years. That's all. It's a respect thing. But you're the perfect person to answer our first question that I want to get to from the social question. By the way, appreciate everybody who's submitted, whether it's Facebook, Twitter, or Instagram. Love hearing from you. We're going to try to get to a few of them. Some great questions. This first one I want to start with is Paul in Danvers, Minnesota. And Paul brings up, he says, John, when you look at the ag economy with inflation and interest rates on the rise, are we in about, say, 1978 or 1979?
I think we're earlier than that. I got into the business in January of 1973, and we came up from the Russian grain robbery, we called it, in '72, where the Russians took a substantial surplus of the world's wheat. We then ran into an oil embargo, the Arab oil embargo, and we had a rampant inflationary period of time. Corn was $1.50 or thereabouts. It had come up from $1, and the old timers said, well, it can't go any higher. It didn't stop till it got to $4. So we're not at the multiple stage, but we are somewhat, because we were at 3 in 20, and now we got up a lot of cash markets at $8. So it is multiple, but we have similar inflation going on. And we're on the front side of that mountain. People keep comparing backwards, and they talk about in the late 70s and when we were maybe starting to come back down. We're still on the front side of the mountain, in my opinion.
Well, a lot of the things that we talk about is the highest since 1982, the highest since 1981, the highest since, because that is when we were coming down off the mountain, is what you're saying. So what should someone do if we're staring the upside of the mountain?
Well, the thing, if we go back and look at what happened during those years, the biggest mistake people made was leverage. People who bought anything and had to mortgage it, it became painful because interest rates didn't stop at the kind of rates we're seeing now. Interest rates went right on up, and there's a lot of farmers out there that I'm sure remember paying interest rates in the teens. And the very best thing to have done was to not have borrowed money or to have it locked in at rates that were more reasonable than that. But from a standpoint of the agriculture economy, the agriculture economy is strong. We aren't seeing a lot of farms sell with much leverage. Most of the farms that are selling, the people are putting sizable down payments, if not paying cash for them. And so a cash paid for farm, there's not much risk in that. Now, the price may go down at some point, but so far, and I asked, we stopped at 25 farm families in the last 2 weeks and talked to them about retirement accounts of all things, and what we asked each of them was, what's happening with farmland in your area? And we had one farmer who said, I think it's down just a little bit. Everybody else, it was steady or better. And they expected the next sale would probably be pretty strong.
However, can they rise at the rates that they've been going at? Will they be up, but maybe not by 4%, maybe 1%?
Well, the rates have been more like 25%. No, we can't continue to go up at those kind of rates, but we can certainly inch our way higher. And we met with one farm family where they own the land on 3 sides of a farm that's coming up for sale. And I'll tell you, that farm could get to be really expensive. So you have those kind of situations.
Do you think agriculture is a good thing to be in right now?
I think it's the best place to be. I mean, I think it's, of all the different industries out there, agriculture is absolutely the best place to be, but you have to be careful with leverage.
Okay. You know what you also have to be careful is recession. George in Clay Center, Kansas asks you, John, if the U.S. goes into a recession, what does that do to all of ag commodities?
Well, you can expect, first of all the commodities to adjust to their own fundamentals. And so part of what's going on here is not just inflation, it's also fundamental tightness. If you look at the ending stocks and compare to prior years, ending stocks as a percentage of usage, we're relatively tight stocks in everything. The crop we have growing in the field must be a good crop. It must be a better than an average crop, or we're going to tighten those fundamentals even further. And then we have to have a good crop in South America. And so we really have those fundamentals that need to be completed before we can take away the tightness and the price that's caused by that tightness.
But how close are we to flipping that on its head and going to major surpluses, and we're staring at nobody wants the grain?
We're not even close.
You don't think we're close?
No. Now, we may find out at the end of the month that something's different, but looking at last month's USDA WASDE report and comparing our supplies to the prior several years, we're down at a very tight level. Beans just inched up off of the tight supply that they had last year. But corn's actually forecast a year from now, the fall of 23, will be a tighter supply if the government yield forecast, which is the same as last year, and the acreage that we received already, if both of those are correct, and the demand is correct, we will have a tighter supply the fall of 23 than we have in the fall of 22. So no, we're not seeing breathing room in any. We're seeing breathing room. I don't want to exaggerate it, but
right.
But we absolutely have to have good crops, and maybe we do. I mean, right at the moment, I think we have good crops in the field in general, but we need to have the right kind of weather from now through harvest in order to bring that home.
All right, well, you just kind of answered Shannon in Iowa's question, but I'm going to ask it anyway because it is very important. I think people understand about the whole what's it doing in my backyard. Shannon's asking you, he says, most forecasts call for limited rainfall the next 6 weeks. That doesn't fare well for the big I states in pollination. Him, in northwest Iowa, he says we're extremely dry. How widespread does the condition need to be to impact the market?
It's widespread enough this year. I mean, right now, it's widespread enough because it runs from northwest Iowa to southern Illinois, over on into Indiana as well. So it's really widespread enough right now. And now the northern part of the growing belt is expected to get some rains. And so it may well be that we'll narrow that worry area. We had some rains come through Iowa in the last 2 weeks, and I was at a farm where they actually had too much rain. They had ponding, and I mean they don't want any more rain for a little bit. So you do have some of that, but for the most part, the widespread crop belt is dry.
All right, let's go back to one of those ponded areas, northwest Minnesota. Tim in Crookston, Minnesota wants to know, the funds are exiting wheat, but with a below average yield in the winter wheat crop and a late planted spring wheat crop exposed to heat and continued problems with exports in the Black Sea wheat exporters, is the exit overdone?
I think it is, and I didn't really expect this kind of a decline in wheat this week, but it's harvest. And nobody wanted to stand in front of the market. We were selling off everything, and so the piano player was taken away as well. And but in the situation in Ukraine, I mean, it has not improved, and they blew up another facility this week,
if not two.
Yeah, so as I see it, the wheat situation is tight. It's just harvest. And when you have harvest at these high price levels, it's not surprising that you have pressure.
All right. I want to get to Phil in Dresden, Ontario's question here. He's talking about the swoon in grain prices. He says it looks like demand has finally cracked, or has it? Did prices go down because non-commercial specs were getting spooked by big USDA numbers next week, or with Russian missiles hitting grain terminals?
I'm not sure that the Russian missiles would be a reason for prices to go down. It might have chased some people away, but to me, that's a reason that it makes me believe that some of that grain that we hoped would be available may not be available. But demand certainly is tepid at high prices. Nobody wants a big inventory of old crop grain at very strong basis levels. So everybody's buying just the bushels that they can use right now and take the margin out of it. Nobody's stretching their neck out into next week and next month. We're a little worried about the weather, and that would maybe cause some people to stretch, but we didn't see that this week.
All right, two questions, and you kind of opened it up right there. I think you kind of answered it. Shane in Alberta, Canada, which, by the way, those of you in Canada, thank you so much for picking up the program here. Shane wants to know, John, are you buying the dip?
Yes, we have buy signals in corn, beans, and wheat. So we think that if a person wants to own, particularly if you've made heavy sales, we advocated some pretty aggressive sales at the higher price levels. For someone who's done that, or someone who wants to be aggressive on the next rally, this is where you buy call options to give yourself some courage and to give yourself some protection in case we've got a problem. At the high prices, we always have some kind of problem. It always makes it hard to sell. And so if you buy the call options now, that gives you some coverage.
Gives you an opportunity on the
Exactly.
other end. All right, last question is going to be Shane in Bloomfield, Nebraska. He says the Illinois and Iowa good to excellent rating is going down and the market not very responsive. Are the grains more linked to technical and money flow now than fundamentals? I kind of asked you some of this question on the main program, but Shane also does a good job consulting it or condensing it here.
That was a real good question. The market moves toward the fundamentals, but it's the technicals that cause it to move. The people who are placing large bets, the trend is your friend. And so they try to follow that trend as best they can. And so when the market is moving lower, they're in selling even though the fundamentals might be very tight. And when the market's moving higher, they're in buying regardless of the fundamentals. The fundamentals will have a little bearing in a trade, but the main bearing is the direction of the market. They're trying their best to stay within the direction of the market and have their equity go up every day. And so when a market turns south like it did this week, the equity and long positions was going the wrong way, and so they get out and move and not waiting for the fundamentals to be changed next week with the government report.
So instead of shifting places in the boat, they're getting out of the boat?
No, they're shifting places. No,
they're just shifting places. They're still in the boat.
They're
You think
still in the
equities
boat.
are still
I
here?
think they're still in the boat.
Okay. And guess what? We're going to ship you off back to home now. Good to see you again, John.
Thanks, Paul.
Thank you so much. That's John Roach. Next week, we're going to talk about the impact of pending legislation on cattle feedlots, and Elaine Cubb will join us to analyze the markets. Thank you for watching. Have a great week.